Let's talk to Matt Yeates. He is a quantitative investment manager at Seven Investment Management. Very good morning to you, Matt, and Happy New Year to you and your family.
To you too, to you too.
Right, so let's talk about volatility. Let's talk about the VIX index. I see with great interest the US commentators are at the most bullish they've ever been in terms of the news writing services, the most bullish since 1987. And yet the VIX is at record lows and volatility is almost been taken out of the market.
Yeah,
What are your thoughts?
I mean, it's as we kick off a new year, it's the time when the inbox just fills up with market commentary and outlook for 2018. And the thing that's so amazing is that for people that have feared this low volatility for so long, it feels like a bit of capitulation in the market that actually there's a reason behind it. And I think if we think about what the VIX is, people call it the fear index. It's not asking people coming out of bank station, how scared are you, how fearful are you? It's basically what's implied by option markets in terms of the price of hedging or buying exposure to the market going forward. And I think really that's so low because it reflects people's expectations of low volatility. Where does that come from? Well, it's coming from the fact that for the first time, we've got consensus growth in all markets almost at the same time. This isn't a recovery that's now built on a leg of the stool from China or a leg of the stool from the US consumer. In Japan, we've got signs of recovery. In Europe, at long last, we've got signs of recovery, as well as in the US and China. So I think low market volatility just reflects the fact that we've now got low economic volatility as well.
Okay, so you've got something like Bitcoin where it's a permanent fast market and the vols are absolutely off the clock. But for every buyer, there's got to be a seller, okay, in the stock markets. And it just strikes me that everything is calm at the moment. What happens if we get a bad number? What happens if we get an interest rate rise out of nowhere? What happens if we get a spike in inflation? What happens if the yield curve suddenly goes, there instead of there? Okay. And the VIX has got to pick up, hasn't it?
No, well, I think what you picked out there are the main fears. You mentioned the yield curve, you mentioned inflation, you mentioned interest rates, central banks. That, for me, I think, is the potential rock that could come down and shake things up a little bit. I think stock market valuations and people's becalmness about equities makes sense in a world where real interest rates are as low as they are. What's the alternative to buying equities in a world when you're locking in negative returns in the bond market after adjusting for inflation?
Yep.
I think the prospect of US inflation is a real one, right? If China stops exporting growth to the world as it did in 2016 and for much of 2017 and starts exporting inflation, I think that's a world where central banks' hands start to become a little bit more tied than they have been in the past. I think the market consistently undershoots the dot plots for the Fed. I think a world where inflation starts to kind of pick up again, that's where what does the new normal look like sort of question starts to come out in earnest. If interest rates start to rise, the opportunity cost for investors of holding equities suddenly increases. And I think that could signal a bit of a rotation out of equities.
Okay, so let's assume that this is the last phase of the bull market and most of the money can be made in the last phase. If I'm watching this now and I'm a nervous bull for whatever reason, okay, do you go 100% cash? Okay, is it just purely a question of allocation? Do I take my equity holding down to 50%? What tips would you give on that?
Yeah, that's a difficult one, I think, because I think a much harder question than when is the end of the bull market going to come is how do you protect against the end of the bull market?
Yeah.
Right? It used to be an easy answer because you could buy government bonds and you could see the extent to which yields could depress further and you get a price appreciation on your bond holding. With bonds yields as low as they are, there's not as much room.
Yep.
So I think what we're doing certainly, and I think one of the answers is to look a bit broader, to look in the alternative kind of part of the market. So hedge funds used to be such a dirty word, high fees, illiquidity, lack of transparency. I think there's some alternative investments are out there which are suddenly kind of not necessarily ticking those boxes that they used to. So, there's some trend strategies now you can get access to at kind of a good low cost. There's some assets like gold, some high quality government bonds, some Japanese yen and US dollar. I think every single one of those independently has some issues with it.
Yep.
But I think a diversified portfolio of diversifiers rather than just relying on government bonds could be one of the answers.
So in terms of diversification, do you think that in 2018 we're going to have these stellar returns that we had in 2017?
I think there's consensus bullishness at the moment.
Yeah. Which
out there
scares me.
Yeah, it scares me as well, but I think that could fuel the market for a little bit longer. I think there's a prospect of good asset market returns across the board in 2018, but I think it will be more volatile than it was previously.
Yeah.
I think the thing to really watch is that inflation story and what that means for interest rates going forward. I think if that starts to really rear its head in any kind of meaningful form, then suddenly I think the expectations for markets, not just in terms of fixed income, but I think also in terms of equities, should be kind of nudged down. But I think the base case now is a reasonably good year, albeit one that's more volatile than 2017 and not quite as stellar as 2017.
Okay, my very last question. If I gave you a Bitcoin, where would you invest the value of that Bitcoin? Which sector do you particularly like 2018?
I think banks is one place to look. I think if we think about the prospects for the yield curve and we think about the prospects for interest rates increasing and people suddenly snapping out of this new normal world, then I think you could see a bit of a pickup in longer term inflation expectations and the yield curve could steepen a little bit.
So would you buy the UK banks?
I think it's difficult. I think in terms of areas of the world that we like the most, Seven and I think are the most attractive, I think potentially Europe. I think that's a story where you've got an economy that's finally rearing its head, is showing the green shoots of growth for the first time, that still trades at a discount to the rest of the world, specifically the US, and doesn't have the idiosyncratic Brexit fears hanging over it. I think if we look at bond markets around the world and that yield curve that's so important for banks, I think there's such a specific story around the negotiations of Brexit and how the central bank kind of interacts with that story that makes it a little bit harder to see the UK as a pure global recovery play. There's a little bit more going on there, which I think is really hard to judge going forward. So European banks would be my pick in terms of sectors and globally.